Hi everyone, so we are here to discuss the question of the chapter security valuation. So the first question is, a company has a book value per share of rupees 137.80. Its return on equity is 15% and it follows a policy of retaining 60% of its earnings. If the opportunity cost of capital is 18%, compute the price of share today using both dividend growth model and Walters model. So the question have two requirements, dividend growth model and Walters model. So first we can write the requirements. So the first requirement is dividend growth model. Okay. So the book value per share means what the an investor have invested. So he have invested rupees 137.80 and the return he requires is 15%. Okay. So the 15% into the investing amount is the earnings. So that means the EPS equal to rupees 137.80 into 15%, that equal to rupees 20.67. Out of this earnings, 60% is retained. That means the dividend is the 40%. So dividend equal to 20.67 into 40%, that is 8.268. We'll round off it as rupees 8.27. So for dividend growth model, we require the growth rate. So growth rate equal to, the equation for that is retention ratio into return on equity. Here retention ratio is 60%. So it is 0.6 into return on equity is 15% into 0.15. So it is 0.6 into 0.15, 0.09, that is 9%. So we got the growth. So in the question it is not mentioned that whether the dividend which we have got as D0 or D1, which is that dividend is just paid or the future dividend. So we'll assume here, we'll just give a note that it is assumed that the dividend is D1. Okay. So P0 equal to D1 divided by KE minus G. So we have the D1 which is 8.27 divided by KE is 18% minus 0.09, that equal to rupees 91.87. Okay, that is the first part of the question. The second part is Walters model. So the equation for that is dividend plus retention, that is earnings minus dividend divided by KE into into R whole divided by KE, that equal to dividend is 8.27 plus earnings is 20.67 minus 8.27 divided by 0.18 into R is 0.15 whole divided by 0.18. When we solve the equation, we'll get 20.67 minus 8.27 divided by 0.18 into 0.15 plus 8.27 whole divided by 0.18. That is 103.35. 103.35. So we'll just cross verify whether the answer is 91.89. Small rounding of differences there. And the Walters approach is 10.35. Yes. So what the answer is correct. So that is for the first question. Now the second question, limited shares are currently selling at rupees 13 per share. There are 10 lakh shares, that is the current shares. The firm is planning to raise rupees 20 lakhs. Okay. So we have three requirements here. One is one right share for every 2 shares held, that is 1:2. Firm offers one right share for every 4 shares held, 1:4. How does the shareholders' wealth holding 100 shares changes from 1 to how does right issue increases shareholders' wealth? So that are the three requirements. Okay. So that is question number 2. So we have to find out the X right price and value of a right in under 3 situations. So first we will calculate for the first requirement. Okay. So the current number of shares per share, value per share and value. Okay. So the current will have in lakhs. Okay. So the current shares is 10 lakhs, 13 per share. So the value will be 130 lakhs. Issue is 20 lakhs. Here it will be 1:2. So here it will be 5. So it will be 4. 20 divided by 5. So the value after right issue is 150 and the number of shares will be 15 lakhs. So we'll have to find the X right price. X right price is basically what is the value per share after the right issue. So the X right price equal here, total value is 150, number of shares is 15. So it will be 150 divided by 15, that will be 10. So the value per share after right issue will be 10 rupees. That is the X right price. And now we'll have to find out value. So the value is, we'll have to think from the shareholder's perspective. So after the right issue, what is the value which he have gotten? That will be the X right price minus what he have paid for the subscription. So here he paid 4 for the subscription. For that he got a value of 10. So what is the benefit which he is getting? That will be X right price minus subscription price. That equal to 10 minus 4 equal to 6. This is value which he have gotten as a whole. This 6 rupees he got because he is holding 2 shares. So this value which he have gotten is for 2 shares. We'll have to find value per share. So value per share equal to 6 divided by 2, that equal to 3. So we'll have the first requirement, second and third. That is the first part of the question. And now for the second part, we'll draw the same table. Number of shares, value per share, value. The first will be same, 10, 30, 130. Here it will be 20. Here it will be 1:4. So it will be 2.5. So 12.5, 150. 20 divided by 2.5, 8. This is like a simple max. I'll just show if we have. So if there is 4 shares, he'll get 1 share. So if he's having 10 lakhs, how much he'll get? That is the question. So it will be 10 into 1 divided by 4, that equal to 2.5. Here 2.5. Okay. Simple basic maths. So we got that. Here X right equal to 150 divided by 12.5, that equal to 12. Value equal to 12 minus 8, that equal to 4. Value per share equal to 4 divided by 4, that equal to 1. First requirement, second requirement and third requirement. So we have done first and second. Now third. We will draw before right, then situation 1, situation 2. Before right it was 100 into 13, 1300. In situation 1 it will be 100 into, the value was not 100, he got 50 shares extra due to right issue. So it will be 150 into 10, that is 1500, minus he have paid 4 rupees for that 50 shares. So 50 into 4, that will be again 1300. Here it will be 125 into 12 minus 25 into 8. it will be again 1300. So we'll just give a no change in the wealth. That's about the question number 2. So the next is question number 3. MNP Limited has declared and paid annual dividend of rupees 4 per share. It is expected to grow at 20% for next 2 years and 10% thereafter. The required rate of return of equity investors is 15%. Compute the current price at which equity shares would sell. So this is the variable growth method. Okay. So we will just draw a timeline. Okay. So currently we are at 0th year and just declared a dividend of rupees 4. For first year is there, second year is there. From first year to second year there is a growth of 20%. From there again 20%, and from there to perpetuity it is 10%. So the value will be 4 plus 20%. It will be 4.8 at first year plus 20%, 5.76 at second year plus 10%, 6.336 at third year. Okay, so we'll have to find the P0. Okay, so what we have to do is we'll have to find the present value of the future cash flows, that is the value as of today's date. So here what we have to do is we'll have to take this to present value at required rate, which is 15%, as the required rate of return is that. This also to 15%, and from here we have to calculate what will be the future price, what will be the selling price. So let's assume that Mr. X is willing to buy the share from Mr. Y. This share is currently with Mr. Y and Mr. X is willing to buy it at the end of second year. So from second year, the value which he is getting is the growth at 10% till perpetuity. Okay, so growth rate is that D1 for him is 6.336, because he know that in the end of second year 5.76 ka dividend is paid, and from next year onwards there will be a 10% growth rate. So he knows that from next year he'll get a dividend of 6.336, and that dividend will be there will be a growth rate of 10%. So from that date, what Mr. X is getting is this. So he knows that the price is D1 divided by KE minus G. So the selling price which we have calculating there is the future price of this share. That is, if someone is willing to buy that share on that day, what he will pay? What he will pay is the future value of that share. That we are finding it using this equation. Okay. So what we will do is we'll just find the P2 equal to D3 divided by KE minus G. That equal to D3 is 6.336 divided by KE is 0.15 minus growth rate is 0.10. That equal to 6.336 divided by 126.72. Now we'll draw a table. Cash flow, present value factor, present value of cash flow. The first year it is 4.8, second year it is 5.76, second year it is 126.72. Present value factor is given in the question: 0.8696, 0.7561, 0.7561. So it will be 4.8 into 174, 5.76 into 0.7561 and 355, 26.72 into 0.7561 105.812, 104.34. So P0 equal to 104.34. Yes, 104.34. So that's it about question number 3.